Welcome to Technical Analysis 201. If you have not already studied and applied the material in Technical Analysis 101 course, then please stop here and study that course. Proper understanding of the concepts in that course is required to understand the concepts in this course. You can access that video by clicking the link here. This part of the Technical Analysis course will focus entirely on the Dow theory. Knowing and understanding the Dow theory will lay a solid foundation to the study of any aspect of technical analysis. Most of technical analysis is an adaptation of Charles Dow's theory. Confirmation and divergence, volume, trends, phases, retracements are all derived from the Dow theory. What is the Dow theory? The Dow theory evolved from the work of Charles H. Dow that was published in the Wall Street Journal between 1900 to 1902. Then, in 1922, William Peter Hamilton put all of them together as the stock market barometer. The Dow theory as we know today was published as Dow theory in 1932 with a complete set of principles by Robert Rhea. Basic principles of the Dow theory. There are 6 basic principles of the Dow theory. 1. The averages discount everything. 2. The market has 3 movements. 3. Lines indicate movement. 4. Price and volume relationships provide background. 5. Price action determines the trend. 6. The averages must confirm. Let us now understand each of these 6 basic principles. 1. The averages discount everything. The indices or averages, for example, the Dow Jones Industrial Average, the Dow Jones Transportation Average, CNX Nifty 50, CNX Bank Nifty, which are a composite of all the constituent stocks, at any given point in time, reflect the collective hope, disappointment, euphoria and knowledge of everyone who knows anything about the financial matters. The effects of coming events are quickly assimilated, and most of the time are anticipated, and the averages reflect everything. While sudden calamities like fire and earthquakes are unpredictable, the averages quickly and rapidly digest and reflect the effects of such incidents. We need to understand here the common behavior seen in the markets often, especially about the central bank actions and company results. Many follow the news and expect some drastic action following a news event. However, it should be noted, if the news was indeed anticipated, then the averages have already discounted the news approaching the event. A minor change in the news does not result in any major change in the markets. Central banks rarely, if ever, take a drastic action, and even so, the drastic abrupt actions get rapidly discounted and it would be practically impossible to get any great advantage of such news. This axiom gives rise to the common saying, buy the rumor and sell the news if the news is favorable, and sell the rumor to buy the news if the expected news is detrimental to the markets. Think about it. It will save you many hours of restlessness. 2. The market has 3 movements. Charles H. Dow defined an uptrend as a situation in which each successive rally closes higher than the high of the previous rally, and each successive low also closes higher than the previous rally low. We have seen this in Technical Analysis 101. An uptrend is a pattern of rising peaks and lows. The opposite of this, the downtrend, is successive lower peaks and lows. This is the very foundation of technical analysis today. There are 3 movements of the averages, all of which are in progress at one and the same time, simultaneously. They can be compared to the tides, waves and ripples in the sea. The first and the most important is the primary trend, the broad upward or downward trends, known as bull or bear markets. Primary trends can unfold over several years. The primary trend or bull market is a broad upward movement, interrupted by secondary reactions, and normally more than 2 years. Prices advance due to the demand created by both investors and speculators. There is no known method to forecast the length and duration of the primary trend. Within the primary bull market, there are 3 phases. The first phase is marked by the reviving confidence in the future of business. The second phase of the bull market is the response to known improvements in the business condition. The third and final phase evolves from overconfidence and speculation, when stocks advance on imaginary and wishful projections. The primary bear market is a long downward movement interrupted by important rallies. The first phase starts when the hopes are abandoned. The second phase unfolds as the business activity and profits decline. The third phase, or the climax, is reached when stocks are abandoned irrespective of their underlying value. The second and the most deceptive movement is the secondary reaction. It is an important decline in a primary bull market or a rally in a primary bear market. Secondary reactions usually last from 3 weeks to 3 months. Secondary or intermediate reactions retrace the earlier phase, from 33 to 66% of the price change. Sometimes, the secondary reaction can retrace the previous primary movement completely, but normally is between 33% to 66% and commonly at the 50% mark. The third and the unimportant movement is the minor movement. The minor movements last from a week to 6 weeks. It has no forecasting value for long-term investors. This is very important to understand because short-term movements can be manipulated to a certain extent. It is extremely difficult to manipulate the secondary reactions and primary trends. 3. Lines indicate movement. A line is price movement within a band of approximately 5% of the value for 2 to 3 weeks or longer. The line represents either accumulation or distribution. Accumulation is when strong knowledgeable hands accumulate stocks and is therefore bullish. Distribution is stocks moving from knowledgeable hands to weaker hands, and is therefore bearish. An advance above the line predicts higher prices and a decline below the line predicts lower prices. When a line occurs in the middle of a primary trend, it is really unfolding a secondary movement and should be viewed as such. 4. Price-volume relationships provide background. Normally when prices move in one direction, volume tends to expand. This indicates that as the trend is moving, more and more hands are joining in the trend and the trend is considered healthy. Thus, when prices are rallying, volume tends to expand. If prices are rallying and volume is seen to be dull, with rising volume seen during the declines, a warning is sounded that the trend may soon be reversed. This principle should be used only as an aid to identify a potential reversal only, because the conclusive evidence of reversal can only be given by the price. 5. Price action determines the trend. The markets are said to be bullish when successive rallies go above the peak of prior rally, while the low of the intervening decline is above the preceding low. In other words, we should see higher highs and higher lows successively. Similarly, markets are said to be bearish when successive declines go below the low of the previous decline, while the high of the intervening decline is below the preceding high. In other words, we should see lower lows and lower highs successively. This is in line with what we learnt in Technical Analysis 101. See this representation of market here. The index shows a bullish trend with 3 highs and 2 lows. Each one of these highs and the 2 lows is higher than the previous high and low respectively. The index rallies after a third decline, but is unable to go higher than the previous high. The next decline takes it lower than the previous low, confirming a bear market at this point. Now see this index here. After the third high, a bear market is indicated as the index falls below the previous low. Many analysts do not consider this to be a bear market, and prefer a more cautious approach and wait for the lower high and lower low to be formed. Here, we must note axiom 4 on volume, to confirm the continuation of the bull market, or the beginning of a bear market. At all point during technical analysis, it is prudent to look for secondary indications and not rely on only one indication alone. Six. The averages must confirm. This is one of the most important principles of Dow theory. There are 2 indices, the Dow Jones Industrial Average and the Dow Jones Transportation Index. These 2 should be considered together, meaning, they should both show the same indication. If the market is truly a barometer of future business, then prices of both goods and services must be going up. It is not possible for only one part of the economy to be doing well, while the other shows a decline in performance. See here, the industrial average indicates a bear trend at this point, but actual bear market is not signaled till the transportation average confirms the same, at the second point. And here, at the start of a new bull market, the industrial average shows the beginning of a new bull market at point 1, and the transportation index confirms the same at point 2. So which average or index is truly representing the trend? It is always the first one to show the change in trend, and confirmed only when the second also shows the change in trend. In India, the 2 indices to be checked are the CNX Nifty and CNX Bank Nifty. Now, having understood the basics of the Dow theory, we are ready to dig deeper into technical analysis. These 6 principles form the very core principles of technical analysis. We will apply these principles in different forms, as we go along this series. Do study the Dow theory shown here, as the principles will help you for the rest of your trading journey. We will dig deeper into the Dow theory in later sessions. May your trading never be the same again.